All right, good morning. We have Dano, terrific member, Clueless A Trading member here at session, private ACS session. Today is the 2nd of January, 2017. I'm still have to get used to saying 2017. This is Clueless A Trading Frank, and we're gonna go through a whole bunch of tactical as well as some broader aspects of the market. And for the next hour or so, I'm sure it's going to be extremely helpful as we move forward into the new year. So, Dano, yeah, so here we go. So bottom line is the last part of December, well, all of December, to be honest with you, was very tricky. To say the least, I don't mince words. Despite some hits, real powerful hits on several stocks, the reality was that the market was very bifurcated. There were sectors moving, and even within those sectors, different sectors moving at different times. Even though the market could be up 100 points, you could see very red on one side of the screen if it was the biotech sector, or maybe the tech sector on a certain day, or the financial sector on a certain day. And even within those sectors, we had individual stocks doing their dance, and the rest of them basically just lying around doing nothing. So the simple reason behind that is because of the way the market turned out this year. I mean, past year in 2016, and it was certainly a very volatile, to say the least. Even though we hit new highs, it was still a very volatile market, and we didn't really see any semblance of a real move on the market, to be honest with you, where it was a systematic move up till after the elections. Okay, so what happened was a significant amount of institutional portfolios, which are run primarily by mutual funds, pension funds, insurance companies, those type of institutional portfolios. They had to do a lot of rebalancing. All right, and rebalancing is something that is no way in the world, Dano, that you can quantify, because they got, those guys generally are basket buyers. In other words, they'll buy ETFs of this, they'll buy ETFs of that. Specific hedge funds, obviously, which are a minority player, believe it or not, hedge funds are a minority player in the overall capitalization of the U.S. stock markets, but they are also the fastest players. We know that, right? They're the ones who basically can be extremely erratic in their moves. They day trade the market like nobody's business. But then they're also, and especially in thin markets like we saw with thin volume, they can sway the market one way or the other. Coming back to the rebalancing part, which is pretty, at least for 2016, is done with. It was a very, very tricky situation. There is no way in the world, like I said, you can quantify that. So that's the reason why we saw some really bizarre movements on individual stocks, as you know, in the latter part of December. So saying all that, the job of my job as a technical trader, and members who are trying to sort of get a grasp on the market, is not to basically say, oh well, we don't understand it, so we can't do anything. Our job is to basically try to see the pictures in front of us, i.e. the technical charts, and try to make head or tail of what we might expect. Right? You agree with me on that? And that is pretty much the reality of the business. Okay, and what happens with a lot of traders, and no fault of their own, but I think everyone, just because the term no fault of their own in a way is kind of, let's just put it this way, it's kind of a excuse, for a better choice of words, because you basically are giving somebody a leeway to basically not do anything or miss out on multiple opportunities. So I don't really particularly like that word, no fault of their own, because we are all to be faulted in what we do. And I think if we start from that premise, from a behavioral standpoint, then we can improve on what we do, right? You agree with me on that, right?
Oh yeah.
Absolutely. It's a very simple thing, but believe it or not, I've, in all these years that I've lived on Earth, and in all these years that I've been actually trying to, coach people and work with people and stuff like that, you'd be shocked how many people don't even understand that simple concept. They're always looking for some sort of excuse to justify their faults, and we all do. But I personally don't justify it. I get really pissed at myself, and I mean it. I mean, I get really pissed at myself because after all, it's personal responsibility, and your biggest competition is not the other guy trading against you or with you. It's yourself. And that is really my motto in everything that I pretty much do. And when it comes to this game of trading, there is nobody to fault but yourself in anything we do. Saying all that, the markets are not easy beings. It doesn't matter. You can do your best and you can still screw up on a trade. But that's just the way it is. Just move on. Life isn't fair. And like I always say, you want fair, go to a nice little, spring fair out there somewhere or a circus. You want fair stuff. This is unfair business, and we are fighting not just humans, but machines in the game, in the battle of trading. Sounds kind of philosophical, but that is goddamn right. Somebody's out there always to take your money away from you. All right? And so that's really, that's the bigger picture. So we try to figure it out. All right, so let's see what's going on here on the daily side. Forget the ES. Let's look at the SPX. I'm going to give you a quick synopsis of what I'm seeing. So if you draw this if you draw this, let me get these lines out. Actually, this one out. So we were trading in a band here, okay, and that band was 2250. Call it 2248 because you're pretty, you're very good at, sort of looking at the levels and stuff. So I just want to enhance your skill in that respect. So we were trading in a band since the 14th of December, all right, mid-December, which was a very turbulent time. Generally, middle of the months are, and that's almost an 80% probability that give or take a couple of days, mid-month, you're going to see some severe volatility. It has a lot to do with technical resets and stuff like that. Funds, a lot of market makers adjusting their books when it comes to options and things like that. And you always get some sort of real slap down or so if you're going higher, mostly on the downside, middle of the month. Just keep that in mind. I've seen that happen over and over again, and it keeps on occurring. So here we are in the middle of the month, December 14th. We hit a as you call it, tactical low, okay, on this side, 2248, and we traded within a band of 2248 to the upper end of the band, which was the highs of the market, 2278 or so. We got there. So basically, actually, the real band that we were trading in, to be honest with you, was, you can see the screen fine, right?
Yes.
Okay, good. So we were basically trading. We never went back to 2278. We hit that mark on the 13th of December, and that was it. And so talking about like being very exact with the numbers. So we traded pretty much in this band here for till about 2270, 2273, and we kept on going back and forth, back and forth. And then we had that very, what we call a waterfall decline on the 28th for there were really no fundamental reasons, to be honest with you. And it was just a big portfolio rebalancing dump. And you got that. It was a dump big enough to shift the Darvas box. You can see that, right?
Yeah.
Yep, exactly. So, the weight of that shifted the Darvas box one notch lower. And we came down, and then we had a doji. Now, one of the key things about dojis are that dojis are considered to be, and you can learn about the finer details of candlestick reading. Just Google it and put it in simplistic terms. In real simple terms, a doji or a cross is a indecisive. The chart is basically flashing an indecisive, undecided signal. Now, doji can move higher. Keep in mind, it can move higher, and it's happened multiple times. There was doji here, the cross. There was one here. You can see that, right? There was one here that lasted, that next day went lower, then had a hammer reversal, and then went higher. This was right before the elections. So this throws a lot of signals off, because at that point what's happening is, and I'm going to show it to you, you're starting to see some internal development on the positive development on the underlying stochastics, for example. Here was the doji. Here was your uptrending. A bounce down and a movement up on the stows. However, that doji on the final day of the year, which was the 30th, started to move higher, but hit some major resistance here, as we know, and then you capitalized very well on that. I didn't actually, play the short side on that particular day, but that was your $2 to $6 move on the S&P. See that? So
Yep.
in the meantime, this particular what we did, and today I'm going to show you the pure what we call positive divergences that are building up. I know I've shown that on a bunch of charts that I put out there. I'm sure you took a glance at it, and but positive divergences don't normally play out till roughly about 36 to 72 hours after it shows up on the charts, and you'll see that as time goes on, you'll see that happen a lot. All right, and the positive divergence on this one, which is where the line started to move higher, and then it kind of buckled a little bit on the end of the year, as most of the whatever it is, it could be tax loss selling by some institutions because they made some decent money on on playing the Trump bounce, and whatever the case may be, thin markets, people panicking. So whatever the case, if you look at this, it is still you hit a low on the stochastics on the 28th. You hit a lower low. You hit a lower low on the prices, right? You hit a lower low on the prices because here was 22.49. You hit a low of 22.34, 15 S&P points lower. Yet, if you look at the underlying stochastics, they were actually higher. So this was a minor positive divergence that's in play. You see that clearly. The stows were down here at roughly about 3.9. And on Friday, despite being down 15 points, or roughly about 90 or 100 points on the Dow, below where we closed at on Wednesday, you still had a slightly higher positive divergence. These are not perfect. Technical analysis is not a perfect science, but these are to take into account, especially when it shows up, just so you know, when it shows up on the daily charts. Now, I had this from Friday, but this was not meant for this chart. This was meant for a shorter time frame. So let me show that to you. So just to recap this particular one, we're moving in a band. We broke that band. Now we're here. Now why, from a purely technical perspective, this move here from the upper band down towards these very powerful moving averages. These are still very powerful moving averages. The 34 and the 50-day moving average are still got a big gaping mouth. The spread between the 50 and the 34 is trading at 22.25. Stop me if I'm going too fast, but I know I'm not going too fast for you. You're getting it. It's 22.25. The 50-day moving average is 21.94. You see 21.95. You see that, right?
Yep.
The spread between this and this is a 30-point spread on the S&P, correct?
Yeah.
You see that? Dan, are you there?
Yeah. Can you hear me?
Yeah, I can hear you now. Yeah.
Okay.
So you got a 30-point. It's called the gaping mouth. Okay. So basically, you got a 30-point spread between the 50 and the 34. This is a very uncommon phenomena. Not reading too much into it, but it's very uncommon, showing the broader underlying breadth of the market is still very strong. Because what happened was, over a short term, between November 7th and end of December, the market basically did two massive waves. Wave 1, Wave 2, Wave 3, Wave 4. Listen carefully. How many waves are generally there in a market, in an intermediate market cycle?
3.
5. Okay, it's
Okay.
Elliott wave theory. I'm not an expert in Elliott wave theory, but I have studied charts enough to have learned from some of the best just by reading. Okay, because this Elliott wave theory stuff is so heavy on mathematical formulas. It just gives me a frigging headache. I'm serious, okay? And the guys who do it, they are like out there. They're really out there. Some of them are right. But Elliott Wave, just so you know, when you have time to read up on it, I'll give you one site, one guy. It's actually, I used to think he was a guy, but it's actually a lady. You know, I do apologize to her. You know, it's because I used to always, I'm dead serious. Name is Tony Caldero. So I'm thinking, you know, I'm a New York guy, Tony Caldero. Hey, Tony, what's going on? I mean, I don't know. Then I find out that Tony Caldero is actually a lady. Smartest, like rocket scientist. And I used to post Tony Caldero when I used to write the blog, and instead I started doing the video cast. But I'm going to start going back to that, because from that one particular site, and I'll give it to you today, I learned so much about these wave patterns and all that stuff. All right, and she's brilliant. She's Elliott wave theorist, but Elliott wave theorists, just so you know, historically speaking, are bearish. They're always bearish, like the world's crashing, like the gold is going to go up $1,000, which we'd like to see. But you know, it's just like they're always bearish. But what she did was she looked at the real pure science of the Elliott wave theory, and she was one of the big names in it, older lady, and she basically called herself the OEW, objective Elliott wave. In other words, and she called the whole bull market, believe it or not. So she was kind of looked down upon for the wrong reasons by the community of these Elliott wave theorist people, because they're like a bunch of like out there kooks. I'm serious. And but she was dead right on everything. So her blog is amazing, amazing. And I'm going to go back to reading it every evening, because you know it's free. You can put out there to do that. Anyway, Elliott wave theory is a 5-stage move. Okay. It's A, B, C, D, E. A, B, C, D, E. That's how it's put. A, B, C, D, E. So if you because from an inflection point, from a starting point, we obviously have to start this journey to where the market's going, where it's going to come down to from election day, correct? You agree with me on that? It's not Brexit. It's not that. We have to use the starting point as to where we might come down, where we're going. This is your starting point. So wave A was this. Then a minor consolidation after a big run is B. Then you get C, which is generally a little bit shorter than wave A, which is the first initial blast up, right? And so then you have C, which is your so this A, B, and then you get C, which is in length, should be under the Elliott wave calculations, should be shorter than A. So you have C here. A, B, C. Then you have D, which can be flat to down, except it was mostly flat. But then if you do it like this, I'm sorry. If you do it like this, it was actually slightly down. So it's nothing but a large consolidation wave, which is larger than this one. Get it?
Yeah.
A, B, C, D. The fifth wave, which is E, starts here. What they generally say is that A equals E. In other words, wave 1 equals wave 5, which is the final wave in an intermediate term move. Generally, what they say is A equals E, meaning the length of this move should equal the length of the final wave, or whatever you call it, the blow off top, whatever the case. Just giving a basic idea. It's not that it happens, you know, but it's happened over long cycles. So if that's the case, then we're going to see a new high in the markets sometime between January and March. A real new high, not like fighting for 5 S&P points like we've been seeing. You got it?
Mm-hmm. Yeah.
And March, generally speaking, just so you know, historically has been, and what does March signify? At the end of the first quarter, correct?
Right.
So generally signifies a major top in the market. Will it play out like that? We'll see. We're in the job of forecasting and figuring it out. We're not in the job of telling people, okay, that's exactly where it's going to be on March. But that's generally how it works. So saying all that, let's get this out. You have a basic idea of that. So when you read the Tony Caldera's thing, you'll understand better. And she has charts and all that stuff. It's real. Sometimes it's just, it's a lot of stuff in those things that they do. So saying all that, the bottom line is that the standard deviation, in the simplest form of looking at it, the standard deviation from this crossover. Remember, this is a very powerful crossover. In some of my charts, I point out the 3450 crossover. You remember that?
Yeah.
You do or no?
Yeah, I do.
Okay, yeah, just checking. But the 3450 crossover is a significant crossover. It's significant. So the 3450 crossover it reignited sometime around the end of November, right? End of November.
Right.
So once that happened, you had that next surge. Now, not always. Now, remember, this crossover occurred while we were having a 5-day correction. See that?
Yeah.
But the momentum of moving averages doesn't change just because we have a 1, 2, 3-day bad day. I mean, the pullback on the market. A momentum changes when there's a sustained downside move. So bottom line is, so despite the chop and the rebalancing and the year-end shenanigans and all that stuff, the moving average momentum is still very strong. Have to keep that in mind in the backdrop of what's going on. Now, if we start to see any of these lines, the 34 and the 50, start to buckle down, that's when you know there is some heavy-duty forward week selling coming. There's some real technical damage being done. Just remember that. So we don't see that yet. And nowadays with the algos and the HFT, these type of technical damages, as you know, or resets happen within hours. They don't take weeks or days. So looking at the daily here, at first glance, going all the way back to, let's say we go all the way back to July, which was the pre-Brexit crash that we had in July. No, this was Brexit. Sorry, this is from Brexit. Yeah, sorry. If you look at it, the moving averages is still substantially gapping up. I mean, are still moving higher. Now, these will act as major support for the market. So the 2225 is a major support for the market. And of course, the 50-day moving average is a major support for the market. In between, you have the Bollinger supports and all kinds of stuff. Now, this is on a more of a multi-week view you're looking at. These are a couple of small things, real simple things, which have made me some serious money over the years, is simply by looking at the first visual glance of the stochastics on the daily. They are in very deep overbought levels. I mean, oversold levels. It does not mean they can't flounder around below the 20 mark. Remember, the stochastics is nothing but the first derivative of the RSI, the relative strength index. Because in the old days, people traded off, some people still do, like you buy below 20 on the relative strength and you sell above 80. Well, it's the same thing with the stochastics too. So every single time, as I've shown on some very powerful charts, we get down towards these levels, we get a reflex bounce, aka dead cat bounce, whatever the case may be. All right. So every single time we have come below the 20 level on a daily basis, you've had a substantial bounce. Will the bounce morph into something as powerful as this? I have no frigging clue. When this happened, we were already long, reducing our exposure I mean, we reduced our exposure substantially because we had 9 days of selling. This is pre-election, mind you. And then we hit it there. And I said, you know what? The market's going to bounce one way or the other. The market's going to bounce whether Clinton wins or Trump wins, because we were technically in deep, deep oversold zone. So there would be a sigh of relief that the elections are over and the market would bounce. And that's exactly what it did. Of course, it was on steroids because of the Trump win. Get it?
Mm-hmm.
So end of the year, we landed pretty much there. So for whatever reason, we have to take that into account. Chart patterns, if you look at it overall, aside from the supports and all that stuff, are not necessarily good because this is a rounded top, right? But if I'll be honest with you, I have tried to short rounded tops and lost a shitload of money over the years, and I stopped doing it because chart patterns itself and completely ignoring the underlying technical internals, ignoring the powerful moving averages, ignoring the fact that the market is still on a big momentum surge despite 3 days of year-end selling, has cost me money in years past. So yes, I keep an eye on the pattern, but by patterns itself, unless you're a real ball player and you got millions of bucks that you can sit on a short for 3 months, which I don't, okay? And even if I did, I wouldn't be doing that, because in between, when you get those 200-point rallies, your $500,000 position on a short would dwindle down to 200,000. It's nobody's idea of fun, even though you could be right at the end game. And that is the trader's dilemma. You get it?
Yeah.
That you know something is going to go somewhere, but if you go against that, against the grain of what the market's doing, it is a very painful thing. So that's something I don't have an answer for. That's, I don't have an answer for. So bottom line is, this is a rounded top. And the rounded top, there's a gap here, which is roughly around 2,200 right there. You see that, Dano?
Yeah.
Okay. And that would be the completion of this rounded top. Will that be something that happens rather quickly at the first part of the year? Maybe. I don't know. I really don't know. But I do know one thing, that I'm going to be a heck of a more tactical and take some very aggressive positions off some support levels, such as the 34-day moving average, such as the lower Bollinger that we are holding right now. I'm sorry, the lower Darvas box we're holding right now, such as the fact that the stochastics are in deep oversold zone and we expect a reset. No question about it. Will happen. Has happened. Will always happen. Unless we have a total market meltdown, in which case it'll stay below 24 days. You got it? So the point is that I have a very cautious eye on this, but at the same time, whatever tactical bounces and reflex bounces I get, I will take my money off the table. However, if this pattern, and this is very important to you, is if this pattern continues with these type of quick bounces and still making lower lows, and just visually you see this dome, okay, keep on acting as major resistance, then obviously every reflex rally needs to be sold, right?
Yep.
There you go. Now, in order to determine that, we have to look more closer. We zoom in, and when we zoom in, we look at the 4-hour. So let's look at the 4-hour chart, which is used by some very serious traders as the short-term trading vehicle, the 4H. The 4H, okay? So let's get all the lines out of the 4H. On the 4H, it is clear as daylight what's going on. You have a double bottom here. Remember, stows can be read just like any other chart pattern. So you got a double bottom here. Okay, this was obviously going back. Okay, so every single time you can see what's going on. So double bottom. Is it not possible to have a triple bottom? Absolutely. Is it possible to have a quadruple bottom? That's a rare occurrence. So when you look at the when you look at the, pull it down, when you look at this here, we are right now on the 4-hour chart. Very powerful chart, mind you, okay? I mean, time frame, mind you. We went below the 50, correct?
Yeah, we did.
Look at the 34, which I always designate as an orange, dark orange line. This one. Now,
Yeah.
between the 34 and the 50, do you see any curvature down?
No.
Not yet. Exactly. We had a 1, 2, it's almost like, let's start off here. 1, 2, 3, 4, 5, or let's say 6, 7, 8. We had 9 days of incessant selling back on, or let's say 7 days if we count or let's count the red candles. 1, 2, 3, 4, 5, 6. We had 6 days of pretty powerful drops, which brought us down to what I just showed you down here at the beginning of December, correct? Look at the date on the keep the date here. It started off actually on November 28th, ended on the 1st of December. Everybody shit scared. And I remember I made some real decent money on the SPX calls at that time, just purely playing on this. And look what the market did. It took off like a rocket. Now, bottom line is that even then, just like now, here we bounced off the 34 moving average. And these are important. These are just like what is technical analysis? You put many different variables and you try to understand how they're relating to each other. Not all of them are going to flash you a buy or sell signal. Some of them, that's why sometimes there are mixed signals. In fact, most of the times there are mixed signals. But I'm just showing you a couple of tricks that you can utilize on anything, whether it be a stock or an indices or an index for your own thing. So bottom line is that just like then, and now we have tested the 50. So now we're further down the chute as in oversold zone, which from a tactical standpoint is things are getting nice and cheap. I know certain things which are getting nice and cheap. So the bottom line is that here we are going to attempt a bounce. You can see a reversal candle starting to shape up on the 4-hour. Now the bounce, if the market is going to go down, wants to go down, where will it hit resistance, you think? Just look at this part.
That 2220 probably.
I mean, the line-wise, it's going to hit resistance at the
in the Darvis box?
Well, on the Darvis, yeah, you hit it. There's a bunch of resistances in front of us. Number one, the closest one, this is how you start, is the yellow line, which is the 5-day moving average, right?
Mm-hmm.
This is the 5 SMA, which I call the traders, sort of quick traders friend. That's at 2245, right?
Right.
Right there. Because remember, it's starting to curve down. That means momentum, at least for the end of the year, which skews a lot of things, is trending down. So let's respect it. So that would be the first, 2245 would be the first resistance. Because if you notice, since we broke on Wednesday, on the 28th, this 5 SMA has acted as consistent resistance, correct? Sure. It just it punctured it, couldn't stay above it. So let's say it hits it. So that's 2245. Next resistance is, as you correctly pointed out, is the upper Darvis, 2255. R3, or resistance 3, would be right between the mid-Bollinger, the midline, and the 34-day moving average, or the 34 SMA. In this case, it's not a 34-day because we're looking at the 4-hour chart. Whichever the case, the 34 SMA, which is 2257. So bottom line is, so where we closed at, we closed at 2238.83. Let's call it 2239, right?
Right.
So the best you can get right now, I would say, is 2259. 20 S&P points. 20 S&P points, roughly 100 to 120 point from where we are on the Dow Jones. It's roughly, I think roughly 6 to 7 points. Let's call it 6 points. Take the middle ground. So one S&P point is 6 Dow points. So Dow closed at 19,762, correct? I mean, I'm looking at it. Yeah, so 19,672. So 19,672 plus 120 points, just to be exact, that's why I'm using, brings us to 19,800 roughly. Got it?
Got it.
And if you look at it, we went as high as 19,945, I believe, or something, or 85, like 15 points, whatever. Who cares? Bottom line is that that's what I'm shooting for as max retracement. If it breaks above that and completes this pattern, I've seen this happen way too many times. If this pattern is completed, that creates a big fat cup. If it breaks above this major resistance of 2259, got it? 2260. So once it creates a cup, what's the next stage the market does?
It's going to hit that huge wave that you were talking about, that fifth wave?
No.
And shoot up?
No. Once from a pattern standpoint, you've heard the term cup and handle, right?
Yeah.
Okay. A cup and handle looks like this, just like a cup and a handle, which is basically a consolidation thing, a consolidation channel. Once you create that handle, okay, and this has happened quite a few times, both in stocks and especially in the indices, it happens a lot. If the primary trend is still up, once it creates a handle, it breaks out. So if we get up here, most probably there is going to be some major profit taking for a simple reason. We hit the old highs, correct? So you're going to be some profit taking. This handle development can last from a couple of hours, if not 2 or 3 days. Within 2 or 3 days, there will be a decisive move, whether it wants to break out and make a new high, or whether it wants to break down and create and retest the lows where we closed that on December 31st. Now, from a pattern symmetry standpoint, if it does this, let's say it doesn't do this cup and handle breakout, it comes down here. It basically creates a double bottom, right?
Yeah.
You see that? Okay.
Yep.
Okay, so double bottom, also known as a W formation or a dragon bullish pattern. If the market is still resilient enough to go higher. A W or a dragon bullish pattern, that's what it's called, is a very powerful pattern. So the bottom line is that if it, while every non-technical people basically all freak out, oh my God, the world's falling apart, this and that, this is where you want to of maximum entry if this consolidation channel or AKA handle breaks below. It happens very quickly all the time. And when you have a dragon bullish, the right arm of the move happens fast and furious. No time to get in unless you place yourself right around here somewhere. Because we don't know what's going to happen once it hits that. Will it break out or will it come down again and move into a sideways channel for the next couple of weeks? We don't know that. But this is how it happens. All right? So the cup and handle formation, just giving you the sort of predictive scenario. The cup and handle formation is possible. That'll be very bullish. Once you get towards the top of the range, it is also possible that it overshoots. It does that. And then create the handle from here. Got it?
Gotcha.
Yeah. Because remember one thing here. Despite everything that you hear out there, funds, retail traders, mom and pop, everyone, no one's fully invested. Markets get fully top, a real top in the market is born. And I am a living testament of it because I was there. I was there in 2000 when the market topped like nobody's business, the tech bubble. I was there when I saw it happen in 2001 at one point. I saw it happen in 2008. Markets top when funds, individuals, institutions are so bullish on the market that they're almost fully invested. Fully invested doesn't mean that 100% of your investable assets are in the market. Fully invested means that you are more than 70% invested in the market. Got it?
Okay.
We are so far from that. Look at us. I mean, I can't talk about other people. Look at me. Am I at any given point more than 60% exposed to the market fully without cash on side? No. Despite all my bullish leanings and my picks and my big ass moves on stocks, no. I'm still playing defense, still doing well, taking my hits, making it back up on the side, all kinds of stuff. But I am still playing aggressive defense. Nobody is playing offense. Show me one person who is super excited about the market. Nobody. And this is happening. It's behavioral finance, all right? This is happening across the board. So these technical corrections back and forth and all that stuff are natural, are standard procedure. But from an overall market perspective, we do not see any joy, real euphoria, real excitement about the stock market across the board. If we had, and I'll give you a personal example, if we had real excitement about the stock market, you would have like 20 people lined up begging to get into clueless day trading. And it's a fact. You know what I'm saying? So even traders who are, so that's just the way it works. So the market is there. People are seeing what's going on, and most of them are doing this. They are basically regretting, and they're totally saying, "Oh man, should have done this, should have done that, should have done that." And then when the corrections come, "Oh yeah, maybe I'll get another chance to do it." Except when the chance comes, they don't do it. And I'm talking about actual traders. Got it? So, and I don't make these things up, man. I've walked through the minefields of these things for years now. And I know what at least the psychology part is. So saying all that, I think we're at a pretty decisive point. It's very, very important from a trader's perspective for us to keep in mind that the 4 hour on the 4 hour chart, that we don't go that these two major lines, the 34 and the 50, don't start to buckle down. If I do a one second. Giving you the exact parameters of what a consolidation channel looks like. So let's say we do the consolidation channel point by point, like first point, second. Shit. Oh, come on. Moving things around screens gets tricky at times. Okay. Just imagine what I go through every day when I'm posting real-time charts for you guys. Like trying to set up the charts in real time, especially the index charts. I'll tell you, Dano, it's sometimes murder, because what happens is when I'm running quad, when I'm running toss, especially when markets are volatile, there's a lot of data feed coming in, right? So
your computer just dumps.
Yeah, it. So computer just gets, so I have pretty powerful. I have like a maxed out. I'm running on 24 gigs of RAM. You're talking real power. Doesn't matter. When I'm trying to structure charts and put lines and stuff on it and this and that, I'm trying to move the frigging mouse, and you know how fast things are moving. Believe me. People like you appreciate that. Most people don't even understand what I go through. And yeah, go ahead.
And I'm on this little laptop, and that just kills it.
Exactly. And so, like you said, you need to the quickest way and the cheapest way to improve your trading accuracy, which is executions and looking at charts or whatever, is to just boost up your RAM. You need high RAM.
Okay.
Simply, your tech guys will tell you that. You don't need extra processors and stuff like that. Processors are good enough to handle it, but just make sure your RAM, your processor speed can handle the RAM. Like I have 24 gigs of RAM. That's a lot. That's a lot of processing power. You know what I'm saying? But
Yeah.
anyway, I mean, it's so critical, especially when we're doing, you know, when we're doing these trades, and especially in these type of markets. So I just drew almost a picture perfect consolidation channel right there. And come on, baby, 1 second, and focus on this because this will determine what's going to happen over the next 24 to 48 hours. So I'm going to put it in white. Because as one of the things about as you're learning technical analysis is that you have to have almost exact contact points when you're drawing your lines. You just can't randomly draw a line. You know what I'm saying? So when you move, so when you're trying to draw these lines, you just can't kind of draw a kind of a cute little sketch. If you want exact numbers, which puts money in your pocket, you need to. So here I have, for example, close to a picture perfect, and it's still fucking blowing up. There you go, like there. You know what I'm saying? And there. So if you look at this consolidation channel, this is accuracy at its best. You can I can clearly see what's going on here. On the 4-hour chart, we went below. This is your consolidation channel. All the points met as much as possible. Got it? These are the two major points here. So what we did was we fell out of it. We created a we created a hammer reversal. You see that, right?
Oh yeah.
And the first.
That was like in the last.
Exactly. That's what they do. In the machines, you know, they paint the tape. In the old days, they called it painting the tape. But here is something you have to realize. This hammer reversal, aside from the pattern, what did it exactly do? It went back inside the consolidation channel. Got it?
Yeah.
Exactly.
Yeah, super fast.
It's super fast, of course. And you'll get used to it. You'll see more weird stuff than you'll ever see in your life. You know? And you've already seen them, but you never realized they were happening because there was nobody like me actually pointing them out every 15, 20 minutes. You know what I'm saying? So that's the fun part of being with our service. So anyway, so now that we are in there, we are in the channel. And right there, as you know, we have the upper end of the channel, now that we have structured it, at 2260. Bingo! Didn't we talk about that on the daily thing just a few minutes ago? There you go. So this consolidation channel, Dano, is going to act as a upper end of the channel, is going to act as a major resistance. Unless the market breaks out of it, it is going to be good old. And if the market wants if the market wants to slide down, this is what it's going to do. Of course, it's not going to look that pretty. I mean, look that symmetrical, but this is what it's going to do if you extrapolate this channel. Got it? Remember, there is a gap here to be filled, 2200, somewhere around here. Somewhere along the line, this gap will get filled. And I believe this gap will get filled sometime around the middle of January, if you ask me. Right there. 2200, which is not bad, which is roughly about 200 points or so from where we are. But before that, it's going to do the channel surfing. And if it doesn't want to fill that gap and delay it for a bit, then it's going to have to do what?
Did it have to go up and break that channel?
Thank you. That's the technical answer. Not go up. That you said the technical answer is in the second. It has to break out of the channel. That's correct, sir. All right. So, and that it has to break out of the channel, and it has to break out with force. Now, that's another key term. When a market or a stock wants to break out of a range or a channel, it's known as a breadth thrust. I have a difficult time always say that word. You have to have huge breadth. That means multiple sectors have to participate in that rally, and you need to have a thrust, which is generally in excess of 100 to at least in excess of 200 points. You can look up the definition of breadth thrust on Investopedia. Okay, a breadth thrust is when you want to break out of the gravitational forces of wherever you are. Now the same thing happens as a negative breadth thrust when the market wants to fall. When the market wants to fall, you will see a big move down, and then it tries to recapture. This was a good example. But it's also kind of a fake out, because 2016, one of the things with 2016 was it was a year of complete fake outs. Mostly upside. The downsides were such big fake outs that I got caught in it twice, and it's not fun. Because here, for example, when you fell 200 points on the 14th of December, didn't it look like it should have? Shouldn't the continuation should have been like that? At least?
Mm-hmm.
Yeah, it didn't do that. There was nothing here which said, oh yeah, we're going to bounce off this level here. I mean, it was midway, so it looked like it went to bottom. But right off midway, it decided to move higher and kill whoever the short buyers were over the next 24 hours with this fat green candle. So that's what machines do. In the old days, this would have a continuation follow through. Not these days, man. Okay. So anyway, so you're clear about the levels and everything, correct?
Yeah, I got you.
So the first thing that I'm going to be watching on a regardless, remember the 4-hour cuts out a lot of the garbage noise that emanates from the 1 hour, 15 minutes, and 30-minute charts, right? Because the 4-hour is basically cutting out a lot of the noise. Why is a 4-hour chart important? What does it signify for the trading day?
It's half the day.
You're the boss, man. Exactly. You know how many times I've asked this question and people have given me the weirdest answers ever? Exactly. It's half the day. That's it. That's why it's so important. A lot of times when I'm watching the 4-hour, I'm seeing green candles on the E-minis and stuff, while the market is red, telling you that the actual players are actually buying. In the case of like on the ES, all they did for both parts of the market. See, on the ES, for example, this is very defined on the 4-hour. What's going on? Look at that. See that? It's very defined. Yeah. Now this bounce doesn't mean you're going to go all the way up here right away. This can get overbought, which is the next point I want to cover. You use Thinkorswim, right?
I do.
Okay, good. And then you're going to be using Quad, and you'll see that you mix both of them up, and you'll be like, whoa. You'll see stuff like you've never seen before. And you just have to interpret them right way. And that's why you're spending some time learning this stuff. So anyway, so this could get overbought right here. If I'm long, here's a hypothetical, not hypothetical, a realistic thing. Let's say I'm long 4 calls of the S&P because I overbought conditions and stuff, very oversold. So the previous day I said, okay, I'm going to throw out 2 or 3 SPX calls for Monday, for Tuesday, whatever. And the market opens up, here. I already know the levels it's going to hit the resistance, but immediately my eyes go here and see where are we with the internals. If the internals are severely overbought, and in the quad part, they really show up like very accurate, because quad has both slow and fast stochastics, right? When I see both the fast and slow stochastics overbought, I don't care. I take my profits and run, and I'm not going to buy anything new, especially when it comes to the S&P or the Russell 2000. Now, on certain days, the thrust is so powerful, it opens up 100, then goes up 300. But those are rare days, right?
Yeah.
And that means, so if I see it move back up in that cluster zone of overbought, while the rest of the crowd's getting excited, I'm a seller. Now, if it opens up here and it's not overbought, it's here, then I know there's a little bit more room to move. After the initial profit taking within the first 5 minutes of trading, as the market opens, that this will surge higher. Now, why does this happen? It all happens because the machines know exactly how many options contracts are on the long side or on the short side. So they will do whatever it takes with speed to move the markets up to levels where the shorts will capitulate and maybe suck in a couple of late longs. That's the reason why these surges happen. Somebody once asked me, how do you know if this thing is going to, I said, I don't know, but I do know one thing, is that if you have a preponderance of negativity, which means there is going to be a weighting or over allotment of SPX puts out there, right? You
Yeah.
can study the put call ratio and stuff, the night before. You can get that from the CBOE. You get the put call ratio. I actually get the call put ratio. I'll give you that link too. You can put your email there automatically. The Chicago Board of Options Exchange sends it to you at 4:30. It's a very handy indicator. So if you see too much enthusiasm going out there, then they'll bang the market pretty much right away in the morning, because that's what the machines do. And then by midday, the market will decide where it wants to go. So without jumbling up too much, if it gets overbought, it's a sell. And then you decide what you want to do after the first initial profit taking. Now, real life S&P trading, these bastards are really bad because they don't give you the prices that you should be getting. I have in many cases sold, let's say I have it at 4. It opened up at 7. Great. I have 4 of them, opened up at 7. Okay, it's $1,200 just directly on that small S&P trade. I take it, and then I see it within 10 minutes go up to 9, 10. And this has happened both on the put side and the long side. And in the meantime, they could have easily moved that in the first 10 minutes. But what they see, and this is, I'm a fast learning machine, just like the machines are, is like the reason they do that because they know human behavior. If they're up on something, they want to sell it right away. So the algos deliberately don't adjust the prices so you get a lower price because they know it's going higher. And there's nothing you can do. You can't put a class action lawsuit against the CBOE on options trading. They'll be like, yeah, right. That's why I call them complete bandits. They are total, okay? Because the Chicago Board of Options Exchange does not, in many cases, adjust the prices, and you get a bad print if you're in a rush to sell. So sometimes it's best to sell most of it, because you're up on it nicely, and then maybe hold 1 or 2, or hold 1. But then what happens if you have 1? That's obviously not, I can't explain. So so just remember that from a real life standpoint, it's very frustrating to get a bad print, still make money, and then see it go up another 30, 40% right after you sell it. Because they know the collective psychology of a human trader, and that they want to sell right away when the market opens, and they're rushing to basically, they're like tweaking around, oh, am I going to get like a 50 cents more or whatever, they're moving, and the algos pick those up in nanoseconds, right? So what do they do?
Yeah.
What do they do? You've gone through it. They keep on effing the prices around you, and then right after you sell it, you see it jump up. And they purposely keep what wide? They keep the spreads wide, right?
Oh yeah.
Yeah, exactly. Well, like I said, life ain't fair, but at least we're aware of the games that's played. Let's do on this particular chart. And the larger a position you have, the quicker you want to get out, right?
Yeah.
Exactly. So they know exactly. So there's just certain things in life we can't control, and that's one of them. Anyway, and then also on the flip side, when you have a real choppy type of market, whether it's Amazon, whether it's Google, whatever the case, I get a nice print. I don't care. I get out right away. And then mostly over the last couple of days, right after that, they fall, right? So,
Yeah.
so I'm like, okay, I did the right thing. I got out. And I did that same thing on Friday. Whichever the case, this is your channel on the 4-hour. Lower end of the channel, Dano, is 22.25. Keep that in mind, 22.25. We need to break out of the upper end of the channel is 22.49. So basically 22.49, is 10 points higher than where we closed at. So if we can, it is going to hit resistance there. Can it bust a move from there? Sure. Now, here's the other thing, very important. First part of January, there's a bunch of things, good and bad, that happens. Number one, there is always the fear that there's going to be a rush of tax selling immediately on the first day of the market. That is a possibility. I doubt it, but that's a possibility. Second thing is that tax selling is met by new pension fund money primarily pension fund money and governmental pension funds, which have to mandate, which are investing in the markets, are mandated by law to put cash that has come in at the end of the month, from automatic 401ks and stuff like that, into the market. Those pension fund managers, in my opinion, at that point will determine, and it happens every single month, but beginning of the year, it's a little bit more amplified, could boost the market. Seeing what's happening in Germany, which is the closest market to us, by the way, that's pretty stupendous. The DAX is freaking going through the roof. And so bottom line is that just be aware of that. There's always the thing of the tax loss selling. I still think that, I'm sorry, not, what do you call tax selling? I still think that, personally speaking, that it's the second half of January that we're going to hit some real turbulence, not the first part, because we already corrected a little bit. Got it? Whichever the case, it is literally going to be, unless we see a discernible trend over the trend line, now that you're clear on it, it is still going to be literally almost like a day, 2-day type of thing. So just keep that in the back of your head. All right?
All right.
All right. Now, last thing I'll show you is times 30. Okay. Last thing I'll show you is trade setups. Now, I know everyone sets up their own charts their own way and stuff, and that's fine. But let me, what I generally do is I will put in 4 columns. I will have one of the columns, look how beautifully it shows up here on one side, right? And now you're still getting used to TOS, right? They have tons of video tutorials and stuff like that, which I myself haven't really gone through it. But there are more advanced trade type of setups, but I just look to see what's easier on my eye. This to me is very easy on the eye if I want to keep an eye on the overall sort of cut out the noise type of thing. But on a shorter term basis, you have to, and obviously you need a bigger screen for that. Let's say you're trading Amazon, right? So you have this. What I do is I've set up a, I want to look at it in a very simple way. So do you know how to set up studies?
Yeah.
Okay, good.
I've got a couple of my own that I have on there.
Okay, good. Okay, so I do the basic one. I use a dynamic momentum index or the STOs, but I've been using this lately, and it's pretty good because it moves very quickly with movements in the market. So I will go to appearances. I don't know why the volume always defaults to blue. I have no frigging idea, because I need my red and greens. Perfect. So this is my basic trade setup. Obviously, I don't look at the daily part here. On the trade side, I am looking at the 1 hour, right? And in many cases, I've put a snapshot of that. And if I'm going to be looking at it where I'm not jumping like a monkey on a hot tin roof or every 5 minutes because the stock is doing whatever it's doing, what do you see in this chart here from a trading perspective on the 1 hour chart? What's the first thing that catches your eye? And I'll give you a hint. Look on the left side.
Yeah, I filled that gap.
Thank you very much. So basically, I can put a stop. Right there. And then I draw my lines. And I tend to do it before the market. Price level, one here, one here, one here, as much as close as I can get to multiple inflection points, right? One here, and that's it. More than 5-6 lines gets a little bit too jumbled up. So this is my hourly chart. I know we're going to hit, that it might hit the gap. It could hit as low as 737, but bottom line is this is the 1 hour chart here. Now, if I want to get very close and I want to keep my trades very, I want to do quick trades, then I switch to the 15-minute, and you can see how defined it is. So I find this to be extremely useful. There are traders who just trade scalp, like maybe they're buying 10 shares for like 2 points. Now keep in mind that I put out my parameters out there. I also trade a whole bunch of common, right? I'm not taking 1,000 share positions on Amazon. Nvidia was freaking awesome. And I'll quickly show you the chart, but I did walk people through right, left, and center on it. So whoever wanted to do it, it was great. And on that one, I took a much larger position because I felt that the risk reward was skewed towards upside, at least for the next hour or two. But generally speaking, I will trade both. I will trade both common and options on this. If I see an Amazon big move, I'll scalp those 4 or 5 points on a couple of hundred shares. So that is depending on what somebody wants to do and what kind of capability they have on their account. You understand what I'm saying? So saying all that, you have this is more clear on a 15-minute. So this keeps me in perspective. Now remember, these lines and these things move just very rapidly. So the closer you're getting to, the more you're zooming in, the more noise you're going to get, right? And that's basically it. I shy away from the 5-minute unless I'm looking to see if there's any big volume coming in. If you look at the 5-minute here at the close, look at that. Even though the price didn't do anything, look at the volume.
Yeah.
It's like out of control. You know what I'm saying? Does it say anything about Monday, about Tuesday? I don't know. But I do know that that was, what the hell? There's way too much stuff on Thinkorswim. How do you close this box out? Like I told you, I'm still.
I think it's on the right hand side there where it says live news. If you just click that, it should take that out.
Oh yeah. I forgot. There you go. Yeah, I know. Because a lot of the times I will be looking at. I look at level 2 quickly sometimes, but this takes too much work out of me. Some people are very good at it. So anyway, so you see that, right?
Mm-hmm.
The acceleration of volume starting at 345. Not that you'd know by looking at the price, which is zigzagged around, but that's freaking huge. Anyway, that's year-end stuff going on. So that's my quick trade setup, and I'll have the bunch of stocks that I'm trading, the fast ones, all set up on a grid, on a simple grid. I don't like having like 30 different things. A lot of traders like that. They have 16 or 20 different things, all kind of piled up, because I'm looking for those hidden movements, so that I can't do that if I have like a grid of 20 different stocks. And secondly, I'm not trading 20 different stocks, so I don't really care. The biggest trick in this business, in my opinion, is all you need is one. There's an old saying, all you need is 1 or 2 things to work out. And how many days have we seen where markets are doing this and doing that? Everyone's kind of, and in the meantime, that 1 or 2 stocks that we're positioned in are going through the roof. That's all you need. Whether it be Allergan, whether it be election, whether it be ICPT, there will be. And that is one of my most powerful goals for 2017, to identify every day something that is the biggest mover and focus on that while trading around some of the other fast positions. And you don't really need much. Leave a couple of quick questions to you, and then we can wrap it up for today. So go ahead.
Well, what about Tesla?
Okay, sure.
We're in that
one
position.
second. Yep. Now, the thing about Tesla, which let's just put it up on an actual chart, is the fact that when it comes to actual logistics, which we talked about quite a bit today, of options trading, Tesla options really react to the price of the stock. And I love that. And they're not as pricey as Amazon. They're certainly not as pricey as frigging Priceline, right? And remember, from a standpoint of the cheapest, as in price, not valuation, from a price standpoint, what are the cheapest options you can buy on the high fast trading momentum stocks?
So I don't know, Google?
Apple.
Okay.
Apple calls are generally between 80 cents and $1.50. But the problem with Apple is you got to buy a bunch for them to really move. The second one, which are cheap and moves when it moves, is Goldman Sachs. You can buy them at $1.50, sell them at $5 on a big move up. You can buy them at 60 cents. They go to 90 cents. Percentage-wise, they're big movers. Google is pricier. Amazon is somewhere in the middle. price line, like forget it. If you want to buy in the money, you'll have to frigging fork out thousands of dollars, which doesn't make sense. And unless the stock makes a 40-point move, which it does a lot of the times, because percentage basis, a 40-point move on price line isn't much. We know that, right? So
Yeah.
the options don't really move. So if you want liquidity in your account where you don't tie up everything in one go, you got to look to see the ones which are the most elastic. In other words, which have the biggest correlation with price. All right. So Amazon's good. Tesla, one of the best. So here is the chart of Tesla, which is so picture perfect. I feel like putting like half my book in there and just going away and hanging out with Nano. All right. So here you have what I was teaching you earlier, a perfect example of a cup and handle. So I'm going to take this point here as your thing. It's got so many multiple formations, it's wild. But I'll show you the bearish side too. You notice through all this rigmarole, all this shenanigans in the market, Tesla never really broke this, during like, big tech fallouts. Only one day was it down quite a bit. So here you have a couple of important patterns. Number one, this is a dragon bullish. Okay? This is your dragon bullish formation. What did the stock do? It did a breadth thrust by a powerful volume induced, this was high volume, induced move above the dragon bullish. Correct? You follow me so far?
Yeah.
Good. Let's do the bigger picture first. Once it did the dragon bullish, it had 3 days of a consolidative move from the 225 level, and it came down and tested what? The same breakout level. 90% of the time when a stock breaks out of a range or a pattern, it will come back and retest to see if that pattern has become support. Very, very easy to understand. All right. It will come back and test to see if that pattern is support. So that's exactly, looking at the daily chart of Tesla, what the stock did to the teeth. All right. Number one. Number two. Somebody might say, hey, last time it hit here, look what it did. Okay. Let's talk about that for a minute here, because that's like retail traders talking. Look at the pattern here. Okay, look at the pattern here. This is not a dragon bullish pattern. This was a random upside kind of wave move. Hit it here, fell. There's no way you can match this pattern with this one. They don't match.
Yeah.
Okay. Now, let's move on. I'll show you multiple stuff here. This also is a double bottom, inverse head and shoulder, right? Which means that the stock could, at some point, create the left shoulder. This is the left shoulder, the right shoulder at 200. That possibility is there if the stock breaks below 210, 205. It will rapidly go down to 200, which will become a major buying point right there. Got it?
Okay.
Yep. That's another pattern, which is, again, we're talking about the probabilities of different patterns here. So you're clear with that, right? Any break below 200, you short the crap out of it till roughly on an inverted head and shoulder. There's your neckline. That's your neckline, right?
Okay.
Yeah. So so 200. Now, here is the other one, the final one, which comes into play. What is this? If you just
That's a cup.
There you go. It overshot, like I showed you on a different zone. It created a handle. Once this level holds and the stock does want to go higher, the handle can measure up to this was a big supply zone where it got hit big time. You're talking about 230, right? There you go.
Yeah.
Now, the other thing to keep in mind is there are people who study the depth of the cup. What is the depth of this cup? Let's call it 213. 213, and what was the low?
180?
It was below 180.
Is it?
1 second. I'll do it. 177. Okay, so 177 minus 214, let's call it 214, is 37 points, right? So there's also another method of doing it. So this is 37 points that the stock, not in one day, but eventually over because Tesla doesn't take that long. Let's say over a month or a couple of weeks, whatever, can go up 37 points. Now, if you add 214 to 37, okay, 214 to 37, you're looking at 251, right?
Yeah.
And 251, I believe, is, and this is not a one-day thing, this happens over a couple of weeks, is, I believe, 251 is, like somewhere here, somewhere in this zone, right?
Oh, okay.
So from a weekly perspective, the stock is not has not broken out yet. From a daily perspective, this is where we are. Now, if it rapidly enters this channel, you know what you're looking at, right? You want to go on the short side, but I'm very scared to short Tesla primarily because other than 2 or 3 times, it's never worked for me. I know. So it's just too heavily shorted, and when it turns around, it just kills you. So I'd rather be a buyer at technical lows than a shorter because there's no way, because there are way too many Tesla haters, right? So that itself skews the short side because there's way too many puts lined up. So there you go. So otherwise, it's also to keep in mind, it's a fast-moving stock. Expect the 1-hour chart works well on playing each of these things here. Even the 15-minute works very well for Tesla intraday trading. Got it? So we shall. Cool. So again, don't lump into it too much. Be quick on the trigger, but at the same time, see, this is one of the things I like to see is pre-market. If the stock is up, I like to see the volume. If the volume is larger than 20,000 shares, you know there are some real players getting in there and something's going on. If the volume's 100 shares, I'm not 100 shares. Let's say the volume's 500 shares and the stock's up 4, sell it right away. Well, not sell it right away, but you know that it's just a retail volume in there. You know what I'm saying? But anything in 5-figure volume range, that means something's going on. And that applies to a lot of the big cap moving stocks. Fair enough?
Gotcha.
All right, Ronnie. So good. So we covered a lot of the realities of what happens in the market. We will we'll continue with that. I'll see you tomorrow, and that's it, boss.
Awesome. All right. Well, thanks, Frank.
No problem. Have a great day. All right. Thank you.
All right. You too, brother. See you.